Guys, if you want to be a good real estate investor, you got to understand the 5 biggest cash flow killers to an investment portfolio and how to properly do the due diligence and acquire real estate, understanding how to underwrite and look for red flags prior to closing on that property and learning it the hard way. As somebody who's worked in syndication, asset management, has a portfolio of rental properties that are diversified in all asset classes, I'm going to tell you guys my experience of working with clients and educating them on what these cash flow killers can do and how to identify them up front. But before we get into it, guys, please like, subscribe, comment below with any questions you have. I'm here to be a resource. I'm not going to sell you any ClickFunnels or any garbage. It's here to give you value and make sure that you're making sound real estate investments each and every single time. Let's dig into it. Number 1, cash flow killer is vacancy. Vacancy is a no-brainer. If it's not rented, you're not getting money. And I want to kind of decipher what this means in 2 different paths. The first path is if you paid cash for that investment property. If you paid cash with that investment property and then you're not getting income, you are slowing down your trajectory to the break-even point, the BEP. That's what I call it. What essentially that means is looking at gross rents, like a gross rent multiplier. How long, how many months is it going to take you to get all of your cash back, which is acquisition costs plus closing costs? And I really want to tell you guys, if you're at a 1% rule, which is 1/100th of the acquisition cost, it's going to take you 100 months to get all of your cash back. But if it's vacant, each and every month you have a vacancy, you're getting farther and farther away of that break-even point. Now, when you're talking about the finance aspect when it comes to vacancy, principal, interest, taxes, and insurance, those are going to be your core debt service costs. Insurance and taxes are actually an expense on the property. The interest, amortization, and the principal is the debt service. So there's 2 parts of that PITI that are actually expenses and then debt service. But I want to speak to this. If it's vacant, you're not getting gross operating income each month. You're having to cover that, and you're still paying down the principal, you're still paying interest, but you're not being able to offset those costs in your LLC or your trust, or if you own it individually, which I never suggest. It's creating a situation where you're losing money. So vacancy, what to look for, guys, is ask for the rent roll. That's going to have the first name, last name, when they moved in, how long their lease is, do they have pet deposits, all of that information. The second thing you're going to make sure is those leases match the rent roll. And you're going to look at the start date and the end date. Are they month to month? Are they in a periodic lease, which means a contractual time lease? And when did they start? So if you ask for the last 3 years of leases, but you're starting to see a situation where leases aren't adding up and there's not like move out date here and then a new tenant moved in a month or maybe 2 months after, you're seeing long gaps in vacancy. And the problem with that is that the demand for that location, the demand for that property could be several different reasons. I just want to make sure that everything that we typically talk about is in the due diligence that we're doing prior to acquisition of property. So what I'm really getting at is that you need to make sure the rent roll and the leases, the last 3 years, don't show these big gaps. Also, you need to make sure that when you look at the location and you do your comp comparison of other rental properties and what they rent for, are you seeing high demand for that rental location that you're trying to acquire? If you're not seeing high demand, you may be seeing this. In a college town, you get 0 to 6 month leases because there's 2 semesters in a college year. If it's not a college rental town or area, you're going to see typically a 0 to 12 month lease. Somebody may move out, but if it's a high demand area, people stay put, guys. They usually will go with the rental increases until the threshold of uncomfortability happens. But if you're getting tenants that are sitting there for 2 to 3 years, that's good. But if you're always seeing new leases and people moving out, could be a bad location, could be not close to jobs, shopping, the general conveniences of what you need. And so vacancy is going to give you a real clear picture of how much demand that rental property has. So look for red flags. Make sure to ask the question to the potential seller, hey, how often are you dealing with turnover? hey, when you do have turnover, how long is it taking you to rent the property out? So guys, number one cash flow killer is vacancy. Number two is repairs and maintenance, guys. I can't stress this enough. If you buy a distressed property, but you don't have capital reserves, liquidity, money in your LLC, money in your bank to deal with the monthly repairs, to deal when it needs a roof, to deal with HVAC when it comes up, guys, these are going to be eliminating your cash flow and your net operating income quickly. So what do you do to protect yourself going into an investment property acquisition? First thing you want to ask is, what capital expenditures or improvements have you done in the last 3 years? Have them give you a list of everything they've updated or remodeled or added or fixed. Next, make sure to look during your inspection period, in your walkthrough, look for things that could potentially be big CapEx expenditures, roof, siding, HVAC, foundation cracks, all of the things that you're hiring an inspection company to look at, and use your own eyes to visually anticipate what repairs you're going to have to do immediately, what repairs you might have to do in the midterm, and what repairs you can put in the deferred maintenance category and just get to on a trickle effect. These things are huge, guys. If you're always getting a repair call from your tenants, your cash flow is going to get crushed. If you always are having to do big capital improvement projects because you bought the property at too expensive cost, and now you have to add $30,000, $40,000, $50,000 for a new roof, you're having to come out of pocket for those expenses, and you haven't had enough time for the rental income to stack up into your account in order to offset those costs. So number two cash flow killer is repairs and maintenance, CapEx. Guys, you have to look for those things. Next, number three is the asset management and admin costs of a property. That could include the QuickBooks subscription, your accountant that you have to pay for each year, the marketing that you have to do in order to get that unit back on the market when you have vacancy. It is the printer paper to print out receipts and invoices. It's all those little costs, guys, that can crush cash flow. It also could be attorney costs when dealing with the admin and asset management of your rental property. And what I really want to talk about this is economies of scale. What do I mean by that? If you own 10, 20, 30, 40, 50 investment properties, typically what you can do is put somebody on retainer, or you can hire an accounting firm to do all of them. But when you only have 1, 2, 3 rental properties, you're having to pay for all of these costs and not spread them across your portfolio. A lot of people don't understand it. When you're dealing with the little things that add up, when I look at our cost expense ratio in terms of asset management, administration, marketing, management in general, not property management, just general portfolio management, what we see is there's actually thousands of dollars each year that stack up. Just to pay our tax accountant this year was like $1,800 to $2,000. So let's look at this. If you're only making $200 in cash flow and you have debt service on that property, that means that after 12 months, you've made $2,400. Well, what happens when your accountant costs $1,800? You made $400 for the entire year. So guys, you need to understand that owning rental property, understanding on managing a portfolio is going to have asset management costs, no matter what way you slice it and dice it. If you have multiple LLCs, you're going to have different subscriptions to different things. You're going to have to do all the accounting, marketing, and management, and also your time. That's right. The biggest thing in all of this, the cash flow killer, is that asset management also has to include your time working on these things. You have to pay yourself something in order to look at it from a real true net analysis of what your operating income is on that property. Number 4, guys, is property management. Guys, if you're going into owning an investment property for the very first time, I always suggest hire a property management company and have them work with you the first and second year. If you don't understand the legality of your state, if you don't understand how to do notices, if you don't understand how to deal with leases and deposits and all of that picture of property management, it is worth the cost in gold. But you need to understand on how to allocate that cost with what you're making on that property each year. If you're hiring a property management and then losing money, maybe with your first investment property, it doesn't make sense to hire property management. But then it should probably ding, 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 red flag. I overbought on this property. I have too high of debt service, and I don't have high enough rents in order to justify me hiring a property management company because of all these costs that I have to associate with the asset management. Property management is typically anywhere between 5 and 6% on the low end, all the way up to 10 to 12% on the high end. And I really want to say that you need to interview multiple property management companies, and you need to make sure that you're making sound property management decisions on who you hire, what's the contract say, and do you have the cash flow to afford hiring property management? If not, it's all on you. You need to educate yourself about all of the aspects of owning rental property. And in my journey as a rental property owner, the first 1, 2, and 3 years, I did all of the management myself until we got to a profitability point, and then I hired a property manager and threw the entire portfolio to them. Now it's about systems, checks, and balances, making sure there's accountability between us, and making sure that each month when I get the statement, it makes sense to me with the repairs that have been requested and the bottom line. Number 5 cash flow killer, guys, and thanks for staying all the way to the end, is, and I want to be very clear here, the interest rate and costs of acquisition if buying with a loan. If you purchase a property not for the best price, but the terms suck, the interest rate is too high, the expenses and closing costs with that loan were too high, not only have you burned up capital in the beginning in order to acquire that loan, but the most important thing is your principal and interest payment is killing your cash flow each month because your interest rate is too high. Guys, when it comes to debt service coverage ratio loans, DSCR, you'll see a lot of low doc, no doc loans, what we call NINAs. These loans are set up for LLCs to purchase properties based upon the cash flow ratio that it makes in comparison to the debt service. But a lot of times they'll advertise like an 80-20 loan to value or 75-25 loan to value and a debt service coverage ratio of 1.2. You're like, oh, this all makes sense. But when you run all of the numbers and then you add debt service to it, guys, you're cash flowing like $50 a month. How are you supposed to insulate yourself from capital expenditures? How are you supposed to insulate yourself from vacancy? So when acquiring property, one of the biggest and number 5 cash flow killer is buying them on good terms. And especially if I'm negotiating owner financing, I want amortization of 30 years, but my interest rate can't be 7, 8, 9% unless my net operating income is just massive. Income potential in all of this, guys, is that your cash flow killer, and the reason I say this all the way to the end to talk about, is based upon your financing instrument that you have in place. Your true net operating income, then your debt service is really going to show you, after I pay my debts and I look at all expenses, what am I truly making? And that cash flow after debt service, that is what I'm getting at. So that number 5 cash flow killer is interest rate and financing expenses that are crushing you. And I want to say that even term is going to affect that. If you're taking a 3-year or a 5-year commercial loan, and every time you have to refinance, you have to drop like $8,000 to $11,000 in fees, that money has to come out of the operating account, which all the rental income was coming into. But every time you have to refi, you have to spend this huge chunk of money just to be able to get a better interest rate or extend your term or start over your term. So guys, when it comes to asset management and it comes to rental properties, number 1, vacancy. Number 2, repairs and CapEx. Number 3 is that asset management and those admin and marketing expenses. Number 4, I can't remember because I have just been throwing out tons and tons of value here. Number 5 is the debt service. And I just wanted to say that if you stayed all the way to the end, if any of this was valuable and all of the transitioning of it, send me a property to look at. I can throw it into my APOD, my annual property operating data analysis spreadsheet. I can look at everything in terms of what you're really making and what you're anticipating in terms of pro forma. And then also, if you have any basis of what your debt service is going to be every month, you can look at that cash flow after debt service and that cash flow before debt service, and to look at, is this a good deal and does it make sense? So comment below with anything that you have questions about. Please like, subscribe, follow. As always, I look forward to talking with you on the next one, and I completely forgot what number 4 is because I'm having a crazy day and I'm getting a bunch of text messages. Have a great day.